Rent or buy? Here are 7 things you need to know before you decide, because the honest break-even point right now isn't what most people assume it is. If this is your first time on the channel, hey, I'm Daniel Morabel, realtor/broker with eXp Realty here in Charlotte, North Carolina. I service both North Carolina and South Carolina. Before we get into it, if this is the kind of content that is useful to you, whether you're catching this on your phone or your TV tonight or your computer on a break, do me a big favor and hit that like button. It honestly helps this channel reach more people who are trying to figure out the exact same thing you are. One more thing before we start. If you're actively weighing renting against buying right now, don't wait until the end of this video to grab the link below. Throw a time in my calendar and let's run your actual numbers together. So without further ado, let's get into it. All right, so number 1, and I want to start here because most rent versus buy advice you'll find online isn't built around the specific market. The national rule of thumb floating around right now puts the break-even point at around 5 to 7 years, meaning you need to stay in a home that long before buying actually beats renting financially. Charlotte's own numbers tell a faster story though. Using a 5% down payment and a 6.5 interest rate that we currently have, the Charlotte-wide break-even in 2026 sits around just 3.8 years, according to the recent local market analysis. That break-even shortens even further in suburbs like Harrisburg, Concord, Gastonia, and Monroe, where entry-level prices are lower and closing costs scale down along with the purchase price. Here's why that gap between the national number and Charlotte's actual number matters so much. A lot of generic rent versus buy calculators use national average home prices, national average rents, and national average appreciation rates, none of which reflect what's actually happening in this specific metro right now. Running your numbers against a national model when you're buying in Charlotte can lead you to a completely wrong conclusion in either direction. Here's the takeaway. If you're planning to stay in the Charlotte area for at least 4 years, buying comes out ahead more often than the national advice suggests. If you're moving again within 2 years, renting almost always wins no matter what. The real question isn't rent versus buy in the abstract, it's how long you're actually planning to stay. And that answer should lead the decision, not the other way around. All right, so number 2, and let's put the real numbers on this, not just a percentage that doesn't mean much on its own. Mortgage rates have been sitting in that 6 to 6.5% range for a while now, depending on your credit score. Here's what that actually costs you. On a $400,000 home with 20% down, your monthly principal and interest payments runs around $1,902 at 6.5%. At 5.5%, that same loan drops to roughly $1,560 a month. That's a real gap, worth over $340 a month, just from 1 point swing in your rate. And that's over a 30-year loan, which is exactly why locking your rate at the right moment and shopping multiple lenders matters as much as picking the right house. A lot of buyers make the mistake of only talking to one lender, usually whoever their agent or the seller's agent recommends, without ever comparing that quote against anyone else's. Even a quarter-point difference between lenders on the exact same loan can be worth thousands of dollars over the life of your mortgage, which is exactly why I always tell clients to get at least 2 or 3 quotes, not just accept the first number they're given. Here's the piece I really want you to walk away with. Get pre-approved before you start touring homes, not after. You've already fallen in love with one. A pre-approval tells you your real number, what you actually qualify for, what your real monthly payments look like before you've invested any time looking at homes you might not even be able to get financing for in the first place. Sellers take a pre-approved buyer seriously in a way they simply don't take someone who's just still looking. This one step saves my clients more wasted time and disappointment than almost anything else I can tell them to do early on. All right, so number 3, and this is where a lot of rent versus buy conversations get pretty one-sided. Homeowners in the Charlotte area spend on average 1% to 1.5% of their home's value on maintenance every single year. On a medium price home here, that works out to somewhere between $4,100 to about $6,200 annually. Roughly $350 to $520 a month on top of your actual mortgage payment. Now, add in closing costs when you buy, typically 2 to 5% of the purchase price, and property taxes and homeowner's insurance, and the true monthly cost of owning runs meaningfully higher than just your principal and interest payment alone. Think about what that actually looks like year to year. Things like a roof replacement, HVAC repair, a water heater that finally gives out. None of these things show up every single month, but they show up eventually, and a lot of first-time buyers budget for the mortgage payment alone. Then unfortunately they get caught off guard for the first time something major breaks down. Now here's the practical piece when you compare renting to buying. Compare it to your full cost of ownership, not just a mortgage payment, because that's the number that actually determines whether owning beats renting for your specific budget. All right, so number 4, and I want to be fair for renting here because it's not just a fallback option a lot of buyer-focused content makes it out to be. Here's a real example. If a renter takes the same $45,000 they would have used as a down payment and invests it into, instead of a 7% average annual return, that grows to roughly about $63,000 over 5 years. Add in the monthly savings from a lower rent payment compared to a mortgage payment invested along that way too, and the renter could be sitting in more than $130,000 in liquid assessable wealth after 5 years, sometimes more than a buyer's home equity would be worth over that same stretch of time, especially once you subtract the selling costs. So what does that mean for you? Owning isn't automatically the wealth building move in every single scenario. It depends on what you'd actually do with the money if you didn't buy, and how disciplined you'd actually be about investing the difference instead of spending it. I'll be honest with you, that discipline piece is the part that trips up this whole comparison in real life. The math works out great for the renter who actually invests that difference every single month without fail for years. In practice, a lot of renters don't do that. The money gets absorbed into everyday spending instead, which is exactly why owning forces a kind of savings discipline that renting simply doesn't require. Your mortgage payment builds equity automatically, whether you're disciplined about it or not. Quick pause halfway through this video. If you're weighing this decision for your own situation right now, you don't need to wait until the end. The link is right below, so grab a time on my calendar and let's run your actual numbers together, not just the generic version. So let's just keep going. All right, so number 5, and this is the Charlotte-specific data worth knowing before you assume every neighborhood appreciates the same way. Over the last 5 years, high-demand urban areas like South End, Dilworth, Plaza Midwood have posted appreciation in the 33% to 41% range. Established luxury areas like Eastover and Foxcroft saw more modest gains over the same stretch, closer to 18 to 24%. Meanwhile, citywide, Charlotte's average home value has grown much more slowly recently, closer to 0.5% to 1% annually over just the past year. A real cool down compared to the pace just a few years ago. That's a meaningful spread. The difference between buying in a top performing pocket versus buying somewhere with flat citywide average appreciation can be the difference between a home that actually meaningfully growing your net worth and one that basically just keeps pace with what you paid for it. Now, location and timing actually drive this number far more than the fact that you simply bought a home at all. So translation, appreciation isn't a citywide guarantee. It's a neighborhood specific, and the areas that appreciate fastest recently aren't guaranteed to keep that same pace moving forward. Buying for appreciation alone without a realistic timeline to actually hold the property is a riskier bet than a lot of buyers assume. All right, so number 6, and this one is simple, but honestly underrated. Renting gives you the ability to move without the transaction cost of selling. No realtor commissions, no closing costs, no timing the market on your way out. Say your life circumstances, a career move, a relationship, anything could realistically change soon. In any of those situations, being able to just not renew a lease is worth real money to you, even though nobody hands you a dollar figure for it the way they would for a mortgage payment. Think about the flip side too. Selling a house typically costs somewhere around 8 to 10% of the sale price once you add up realtor commissions, closing costs, and any repairs a buyer negotiates after inspection. On a $400,000 home, that's $32,000 to $40,000 just to exit the property, regardless of whether the home appreciated or not, if you have to sell within a year or two of buying. That cost alone can wipe out whatever equity you'd built up to that short window. Bottom line here, don't treat flexibility as a soft emotional factor separate from the financial math. It's a part of the financial math because the cost of being locked into a home you need to sell quickly can erase a lot of the equity gains you were counting on in the first place. All right, now number 7, and this is the one most rent versus buy content completely leaves out. Insurance costs can be climbing for both renters and owners, but landlords are increasingly passing the rising insurance and maintenance costs directly into tenants through higher rent, rather than absorbing the costs themselves, of course. This isn't unique to any one city either. It's a broader trend playing out across the rental market. Insurance carriers raising rates on landlord policies, property taxes climbing in a lot of counties, and landlords adjusting rent at renewal to keep their own numbers working. The idea that renting insulates you from rising costs isn't fully accurate anymore. Rent increases are often just delayed cost increases, passed through a year or two after the landlord absorbs them first, which is a worthwhile factor to know if you're assuming your rent will stay predictable over the next several years, which it probably won't. Let's break both options down directly, starting with renting. The pros: flexibility to move without transaction costs, no maintenance costs or uninspected repair bills, lower upfront cash required to move in, and the ability to invest the money you'd otherwise use as a down payment, if you're disciplined, of course, about it. Now, the cons: no equity building, every payment is simply gone once it's paid, rent increases you don't control, and no long-term cost predictability, since your housing payment can change every single lease renewal. My personal take: renting is the right call for anyone with a real chance of moving within the next couple of years, or anyone who honestly doesn't have the reserves yet to comfortably absorb a down payment. It's not a consolation prize, it's the financial correct choice for a specific set of circumstances. Now, buying. The pros: things like building real equity with every mortgage payment, payment stability, assuming a fixed rate mortgage, of course. Your principal and interest won't change for 30 years. Potential appreciation, especially in the right neighborhood, and genuine control over your space. No landlord approval to renovate or make it your own. Of course, if you live in an HOA, that doesn't apply if you're going to do something outside. Now, the cons: real upfront costs, down payment and closing costs, things like ongoing maintenance, responsibility, less flexibility if your life circumstances change quickly, and a real transaction cost if you need to sell before you've had time to build that real meaningful equity. Now, my personal take: buying makes sense once your timeline supports it. Generally that 4+ year mark we covered at the start, and once you're honestly accounted for the full cost of the ownership, not just the mortgage payment. When those two things line up, buying is still one of the strongest wealth building moves available to the average household. It just isn't the automatic right answer for every single person every single time. Renting wins on flexibility and lower upfront risk. Buying wins on equity building and long-term cost predictability, assuming you're staying long enough to clear that break-even point. The honest answer depends on your specific timeline, your specific budget, and your specific plans for the next several years, not a generic rule of thumb that wasn't built with your situation in mind. If there's one number I want you to walk away with from this video, It's the 3.8-year Charlotte break-even point. Compare that against your own realistic timeline, not the wishful version where you might stay forever. So here's what to do next. The link is right below this video. Grab a spot on my calendar and let's run your actual numbers, your timeline, your budget, your goals, and figure out which one actually makes sense for you. And if you don't have a lender yet, I can connect you with one I trust free of charge. And like always, thank you so much for watching, and I'll see you in the next one.